Special commendation to the President. I don't know if he's here. I've not looked at the participant list, but he's been driving a good agenda for the last 2-3 years, and we keep soaring to new levels. In terms of the actuarial profession, we have an annual convention. So for members here, just a heads up, our annual convention for the Kenyan actuarial fraternity is in 6 weeks. So please sign up. And if you need any more details, John, our secretariat, is here to enable that. So 6 weeks, it's counting down quite quickly. Thank you for being here, David, who leads the working party and is the moderator today for the IFRS 17 session. And in terms of the session today, it's a very timely one, thanking the team from Swiss Re in terms of the reinsurance solutions and opportunities that exist to help manage all the volatilities expected in the coming 15 months or so. So counting down quickly onto implementation. I think I'll pass back to Limo to allow the team from IFRS 17, the very competent team, to introduce themselves and take us through today's program. So thank you and welcome everyone from TASC.
Thank you so much, Sahib, for that. And again, I'd like to say thank you to the TASC Council that is supporting us on all matters actuarial, including IFRS 17. And special thank you to the IFRS 17 Working Party for the amount of work that you've been doing over the past, let's say, one or 2 years in terms of IFRS 17. Really appreciate the effort has been put and the discussion that we have been having. And remember, a few weeks ago, we had a session on reinsurance at the Working Party, and a number of things seemed like gray areas, and it was timely to have this session with the Swiss Re team. Swiss Re being, I think, among the top 2 largest reinsurers in the world. So we had a session with them, and then we discussed and said it was fit for them to come and present in such a forum. So I'll hand it over to Mukami, who's going to introduce the team, and then they can start, and we'll try and make sure that we are done within the allocated time. Mukami?
Thanks, Limo, and good afternoon, everyone. So my name is Mukami Njero, for those I haven't met. I look after life and health clients for East and West Africa for Swiss Re as part of the Middle East and Africa team. And I'm actually a member of the TASC Council as well, and also a member of the Council of the Institute and Faculty of Actuaries. Swiss Re Africa is proud to be associated with the journey that the insurance industry is on as it relates to the implementation of IFRS 17. Thank you so much to the IFRS 17 Working Party and to TASC for the invite, and we really look forward to this discussion. IFRS 17 introduces a dramatic overhaul of insurance reporting, and Swiss Re has been quite involved in this journey since 2017, including global initiatives on the IFRS 17 standard. We are part of the international response from the insurance industry to input into the shaping of the standard, and we've had industry forums in most continents. This is actually our 3rd seminar in the region. We have developed our own internal value proposition, including process and structural changes, and we have a dedicated IFRS 17 cross-functional team, from which some of the expert members are represented here today. We've engaged with multiple clients, consultants, regulators, and other stakeholders on the journey and path towards implementation. We are running internally our own implementation and stakeholder sensitization across jurisdictions. So we are fairly confident that we have a good idea on the challenges and potential opportunities that the standard presents. And we are fairly confident that our solutions address these key challenges. And this is based on a mature understanding of managing reinsurance under IFRS 17. We really look forward to engaging with you on this session. And unfortunately, it wasn't in person, but we hope that in future it will be. By now, we expect that insurance stakeholders would at least have understood and started to address the operational implications from the implementation of the standard, which include aspects of people, processes, and systems. We are aware that there are multiple solution providers offering options on the systems front, And we would really encourage players to assess the same with their consultants and other advisors. And we can also give views to our clients. Internally, we actually have developed our own financial system with SAP for our own IFRS 17 journey. If we go back to the Slido, I see most of the representation here is actuarial, so thanks for that. We'd also just really like to understand where you are on your IFRS 17 journey. So how many of us have actually seen their first cut of IFRS 17 financial statements? That's the second question. Okay, I am pleasantly surprised. Almost 40% at yes. So that's quite a good improvement from where we were. Of course, we would have liked it to be the other way around. By now, we also expect that insurance stakeholders would have understood that managing reinsurance is more complex than it was in the past. We expect that a significant part of the transition exercise will be an understanding of the features of your reinsurance contracts, whether from a contract boundary perspective or any other perspective. So my third and final poll question, after this you can use the Slido for questions, is how many of us have actually assessed their reinsurance contracts held with respect to IFRS 17? I know there's been quite some traction on reinsurance optimization, reinsurance management initiatives, but specifically with respect to IFRS 17, how many of us have done any assessment on their reinsurance contracts? Okay, so again, a bit of majority no and don't know. So thanks for that. So there's a natural business case for the use of reinsurance in managing volatility in the profit and loss statements and in preserving balance sheet stability. And we will be able to highlight how reinsurance solutions can be a strategic lever on this journey of IFRS 17 implementation. At Swiss Re, we've also refreshed our brand promise to Partnering for Progress, highlighting our partnering spirit and the importance of moving our clients' businesses forward. And this is just one example of the same. So without further ado, I'll hand over to Neil and Maja for the technical presentation.
Good afternoon, ladies and gentlemen. My name is Neil Johnson. I'm a finance professional with Swiss Re Africa Limited. As part of my responsibilities, I look after legal entity financial management, including regulatory reporting, IFRS reporting, legal entity capital management, which also includes running the local reinsurance program within the group, and also the local tax affairs. With me co-presenting today is Maja, and I will ask him to introduce himself.
Hi everyone, my name is Maja Erdouar. I'm a senior business development manager with Swiss Re, and I'm looking after the origination of financially motivated reinsurance deals.
Thanks, Maja. So the topic that we've brought to you today is titled Reinsurance Value and Opportunities in IFRS 17. We decided on this topic because we feel that, that it's a very important topic to cover at this stage of IFRS implementation. As always, and this will be our views shared today, and we invite any further discussions as this is a complex topic. So why did we decide to bring the value of reinsurance? We feel that as the standard was rolled out, reinsurance has gotten a bit of a bad rap, with a lot of focus on the problem areas and the challenges with reinsurance. So these were broadly covered by the consultancies in the industry. However, we'd like to take as a starting point, just providing some context for where we're at. So on the first impressions, when the initial standard was initially issued, reinsurance just did not work. On the assumed side, one had to take your initial losses up front, but your reinsurance recoveries only happened over time. The standard was amended for this and to a large extent then corrected. The separation of your reinsurance from your direct portfolio automatically results in a lot of potential mismatches. This has absolutely been the focus of many industry consultations. However, from all of our discussions with clients and all the research done, we've concluded that these can either be managed or they will just become part of the new normal. There's, of course, a lot of added complexity in the valuation of reinsurance, including things like a lot of additional data requirements. With reinsurance specifically, the potential that one has to value your new business, which is not currently part of the plan. However, again, these things will become part of the new norm, and it just requires a lot of initial setup. But probably the most underappreciated one is that the P&L presentation is now also separating the accounting for reinsurance into a single space. And this will bring a lot of new transparency, just like it does with direct business, which is essentially what IFRS 17 is all about. Of course, insurance cycles span beyond the accounting view of the financial year, and therefore the value of reinsurance is not always easy to measure. And one needs to use this to actually allow for clear communication of the benefits of the reinsurance storyline, also put against the backdrop of the overall reinsurance strategy. And to do this, one can make use of some KPIs, which is something we'll also look at a little bit later. So not to take away from the fact that the reinsurance is a big animal, but we're going to venture out to say that it's still just a change in accounting, and the value of reinsurance remains as before. On this slide, you will see that we've very simplistically depicted out the various value components coming from reinsurance. So I just want to run you through this quite quickly. Reinsurance has and continues to be a key mitigant of volatility. IFRS 17 exposes the different sources of volatility, such as continual assumption updates, actual versus experience adjustments, which hits the P&L as it emerges, and the fact that all balance sheet items are always discounted. So reinsurance actually provides prediction on all these levels. And what's important to note is that this is not only P&L volatility, but also on the balance sheet, with specifically the CSM, or the future profit, being an explicit balance sheet line item. CSM arguably becomes one of the most important value metrics and will receive a lot of attention from analysts and stakeholders. And this reinforces again the danger of just taking a P&L only view when it comes to reinsurance. Without the aid of discretionary margins and the best estimates, reinsurance becomes increasingly important in managing volatility in the insurance result. And later on, Maj is also going to talk us through a solution that will help exactly with this. Secondly, onerousness is another new source of P&L volatility, with loss-making groups of contracts hitting your P&L immediately, where the profitable ones are deferred over time. So these accelerated losses can be absorbed by reinsurance through a mechanism that's called the loss recovery component. And we're going to take a closer look at that in a moment. Again, later on, Maj is going to talk us through a reinsurance structure that's tailored exactly to talk to onerousness. On solvency, under risk-based frameworks like we have in Kenya and South Africa, the IFRS financials might not indicate all the economic benefits that come with solvency relief from reinsurance. Now, I understand that in Kenya specifically, regulatory capital can only take credit for proportional reinsurance and not for non-proportional reinsurance. So this is maybe less relevant in the Kenyan environment, but I feel that it's important to also give a little bit of context from elsewhere in the world, where regulatory capital is limiting your dividend capacity. Then reinsurance does become a really important tool in order to unlock that trapped capital. So considering what we also know from IFRS 17, which will remove zeroization of negative reserves, and in many markets, this will result in a massive release of prudential margins on the IFRS 17 balance sheet. That will ultimately lead then to an increase in IFRS equity for many insurance companies. So the impact of this will then be that the return on equity metric, which is something that seems to be quite liked in the market, is something that will be diluted with your IFRS equity shooting up. One therefore needs to continually assess the impact that reinsurance can have on managing equity and managing your solvency levels. And this is also a good argument for the regulatory capital regime allowing non-proportional covers to actually provide solvency relief. As for liquidity, there's another classic reinsurance benefit, which is still available in the financial reinsurance structure, which allows an insurer to monetize its VIV through receiving an upfront commission payout from the reinsurer in exchange for future earnings. Now, there's no longer any balance sheet uptick, as we're already on a risk-based capital framework, but there's definitely a continued liquidity benefit to be obtained from this. IFRS 17 also brings transparency about the cash flows, both your actual cash flows and your expected cash flows, and any impact on those over time. We've also picked up that there's a renewed focus on liquidity by regulators following the global pandemic and the impact that this has had on the insurance industry. So it's important to consider how reinsurance can aid in managing liquidity. Lastly, just on risk transfer, reinsurance is an important strategic tool to manage portfolios within defined risk frameworks. And of course, there's always the value add from your reinsurance expertise on the reinsured risks that have been passed on. In IFRS 17, the reinsurance risk adjustment is in fact a metric which shows just how much risk an insurer has transferred to the reinsurer. So interestingly, the reinsurance works as double whammy on the risk adjustment, that it provides a reinsurance risk adjustment, but it can also play into your gross risk adjustment, which is something that Maja will again talk about a little bit later. So just one interesting observation also about risk transfer is that IFRS 17 does not regard the transfer of lapse risk as insurance risk. The reason for this is that it's not transferred from a policyholder, but lapse risk is in fact created at the level of the insurer. It's only when it's then transferred via reinsurance that it becomes insurance risk, which creates an interesting position that there's only one transfer of the risk, and that is from the insurer to the reinsurer. So some regulators have taken interesting views on this, and Switzerland notably, the Swiss regulator has initially not allowed the reinsurers to write lapse risk as it's seen as a direct business. And in the Netherlands, the Dutch tax authorities started charging premium taxes on the reinsurance premiums, whereas normally only direct premiums would be subject to these taxes. In Kenya and South Africa, we're not aware about any issues around this, but I think the key principle is that it's important to distinguish between risk transfer for IFRS purposes and risk transfer for regulatory purposes. They are not one and the same. On this slide, we are setting out just how reinsurance interacts with the different sources of profits in the P&L. So maybe just running it from left to right, reinsurance can optimize the risk adjustment and thereby also impact on the release of both the risk adjustment and the CSM, both of them being sources of profit, but with different earning patterns. The reinsurance CSM, of course, also absorbs any assumption changes on the direct CSM. So any net CSM released to the P&L is also impacted by reinsurance. There's a direct impact on the P&L from experience losses, which is diminished then by reinsurance recoveries thereon. Future losses are accelerated and recognized immediately when a group contract turns onerous, and the reinsurance recoveries provides good protection against that through the loss recovery component, as we'll see on the next slide. And then lastly, obviously, there's a price which is captured in the P&L. And good times, when there's low reinsurance recoveries or where the purpose of reinsurance is really for capital relief, then one would expect this to be an expense item. But as we've seen over recent times, when a reinsurance is really needed, it can also become a source of profit as it buffers against poor results. So what we're going to look at now is a slide that shows us the working of the loss recovery component, which is essentially how reinsurance provides the benefits on the direct. So what I would like to show you here is that we've got 4 quadrants where your left top is showing your assets on the balance sheet, your top right is showing your liabilities on the balance sheet, the bottom left is your expenses on the P&L, and your bottom right is your income in the P&L. So when one looks at your direct portfolio, your valuation of your cash flows can either be an asset or liability. At the initial recognition, this then determines what your CSM is. But from there on, they get delinked and the CSM takes on really a life of its own. The cash flows can change for various reasons and the CSM changes for other reasons, but the communal factor there is any changes in expected cash flows. Where there's any change in expected cash flows, it will ultimately impact your CSM until the point where your CSM is reduced to 0. And from there, it then becomes a loss component, which is recognized in the P&L as an expense. Let's compare this to your reinsurance side. On the reinsurance side, you will see that you have also your initial cash flows determining your initial CSM. Again, it gets delinked after initial. On the reinsurance side, however, your CSM can either be an asset or a liability, whereas on the direct side, it could only be a liability. The way to think about the CSM cost as an asset, as one can see this almost as a prepaid expense that will be amortized over time, or if it's a liability, a CSM gain, which is essentially a deferred profit, which will also be amortized over time. Now, from here is where it gets interesting. What we see in this purple block is this is the loss recovery component. The loss recovery component is actually less dependent on what's happening in the underlying reinsurance than it is on what's happening on the underlying covered portfolio. So as we mentioned, a change in cash flows on the underlying can mean a change in your underlying CSM or a change in your loss component. But when we get to reinsurance, a change in your cash flows can impact either CSM or loss recovery component. The loss recovery component, however, can only exist when there is an underlying loss component, but it can coexist with CSM. Interestingly, there's also the potential to interact between your CSM and your loss recovery component without any change in the underlying cash flows. So there's quite a few technical examples that are also covered in the standard, and we can happily talk about that after the session. But for now, I think this just shows how the loss recovery component provides credit over the loss component. Essentially, there's a lot of complexity in these interactions, and it's certainly a huge challenge to gear up systems to actually handle this. But the outcome is, in the end, that there's a nice matching of the reinsurance recovery versus the direct losses, and both the P&L and in CSM volatility, thereby smoothing your results over time. So just a few notes on the loss recovery component. It has to be in place before the onerousness of the underlying happens in order to be taken into account. The loss recovery component is calculated as loss component multiplied by the expected recovery of losses by the reinsurance on the underlying groups. And this relationship between the recovery and the underlying, the standard requires there to be a systematic and rational method of allocation, which we'll also look at on the next slide. And then just lastly, as one can see, there is complexity in aligning the reinsurance with the underlying. And therefore, even though the standard says that a contract is the lowest level of granularity for a group of insurance contracts, we do believe that in terms of the substance over form principle, there is also scope to break a reinsurance contract down into smaller components, particularly where it is managing different lines of business, so long as it still requires the criteria of level of aggregation. And this is also an important topic that one needs to explore. Just lastly, on this slide, we can see that there is, this shows a couple of examples of how the expected loss recovery calculation is done. So if we look on the proportional side, here's an example. Let's assume that each of these three reinsurance contracts have got expected losses of 100. So there's a single reinsurance contract that covers this group of insurance contracts, which comprises of 3 insurance contracts. One of them is covered by a 40% quota share. The second is covered by a 25% quota share. And the third is not covered by the reinsurance at all. How does one calculate then the reinsurance recovery percentage? One takes the recovery of 40 from number 1, plus the recovery of 25 from number 2. And this is divided by the total expected losses of 300, being 100 from each of those. And this then gives us a roughly 22% recovery. On the non-proportional side, let's assume a stop loss cover with an attachment point of 150. And let's assume that from initial, there's expected loss of 200, which then changes to a loss of 250. So the retained portion always stays 150. But in the initial phase, there's a recovery of 50. And later on, there's an expected recovery of 100. So the calculation of the recovery percentage is simply 50 over 100, and 50 over 200 in the initial calculation, coming to 25%. And later on, it becomes then 100, which is the expected loss recovery, over the total loss of 250, which is 40%. So what one can see here is that the ratio is determined per individual reinsurance contract, and the ratio can definitely change over time, like before and after insured events, and it can definitely change to changes in the underlying or changes in the underlying assumptions. So with that, that sets up, I think, us to go into the next section where I'm going to hand over to Marja, who's going to then also talk to us about some of the potential KPIs and solutions that reinsurance can help with.
Thanks, Neil. Happy to do so. So can we move to the next slide, please? So IFRS 17 will be a major change in terms of accounting framework, and the presentation of the statements will be quite different. So as you know, some of the items will not be there anymore. If you look at the premium and top line disclosures, I mean, these will not be present anymore, but it will be replaced by the insurance service result and some other items that weren't there before and that will need to be catching the analyst's attention. So, so more simplified balance sheet with fewer line items, but more granular disclosures. So the granularity of the disclosures will indeed increase. So we will have the roll forward tables. So there we will have the details of the changes between the opening balance to the ending balance with a lot of steps in between. We'll have the CSM emergence table as well, where we will see how the profit will emerge in the next few years. The risk disclosure will be a bit more detailed around both the underwriting and the financial risk. So you see that the presentation of the statement will, of course, change quite a bit. And this will change, of course, the way we steer the business and the indicators we look at when we want to take business decisions. Now, I just selected a few of the KPIs that, you know, from our discussions with analysts came out as being the ones that would be in focus. So if we move to the next slide, this is not an exhaustive list, but it's just a few KPIs that we thought would be of interest. The first two on the left-hand side will be in the primary statement, so the return on equity and the simplified combined ratio. Whereas the two on the right-hand side will be more on the footnotes, but still are quite important to understand how the business develops. So maybe let's take them in order. For the return on equity, the definition of the return on equity does not change, but the disclosed value will, of course, change, and especially because of the transition items. And I will get into that when moving into the solutions mode. But when you will be coming up with the opening balance sheet, there will be some transitional effects that might bump up or down some of the KPIs, and the ROE will be one of them. You know, it's always a trade-off between CSM and equity in the way you park the profit, and depending on how you achieve this trade-off, the return on equity value will of course be different. So the next one is the simplified combined ratio. So the definition of the combined ratio will change as well, and this will affect a lot the P&C insurers. I mean, as you know, so at the moment it's not in present value in the way we calculate the combined ratio, but going forward we will use projected cash flow values, so it will be more on a present value basis, and it will have a more economic meaning. Another thing is that there will be more flexibility in terms of what we are showing, whether it's the gross or the net. There will be as well some, you know, very detailed elements around the treatment of acquisition expenses within the ratio. And all of these items will play a role in you know, the value that you will get out of it and the comparability across firms in the industry. So the new business contribution is also a key one, because it says how much new business versus in-force CSM, because it compares the new business CSM to the stock of opening CSM. In this ratio, of course, we take the onerous business into account to make it a bit more fair. but this will exactly say to which extent the business you're writing contributes to the overall profit. And the next one is the sustainability of profit, and that's a key one as well, because it states how much new business CSM release you have. I mean, how much new business CSM comes into your book versus the current year's release. And that says whether, I mean, if you have this ratio larger than 1, it means that you are growing the business in terms of profitability, and that's a good sign typically that we coordinate. And that helps us as well get the feedback and the experience from various countries. And that's very useful when defining the solution. So we classify these solutions into 2 groups. So the first one is the pre-transition. So these are the solutions where we see issues happening and at the moment when people are coming up with the opening balance sheet, and that have to be solved before the transition. And the other ones are the post-transitions, and these are more solutions which aim at helping our clients manage and navigate the business environment after the implementation of IFRS 17. So let's take them in order. I'll start with the pre-transition one. So the fair value solution is a very interesting one, because you're probably all in the process of coming up with this opening balance sheet, and this requires quite a bit of effort. Probably a lot of consultants involved, a lot of resource investment in terms of IT and systems. But the valuation piece is also a critical one, and essentially to come up with the valuation of your in-force book for the opening balance sheet, you have 3 methods. So you have the full retrospective, and if this doesn't work, you have the modified retrospective and the fair value approach. The full retrospective, foresees an application of IFRS 17 from the year of inception of the contract, and it's a process which is heavily data driven and very time consuming and resource consuming. And in the case, so this is a mandatory step, and if you are not able to proceed with this one because of M&A or changes in IT systems where you lost the data, you can go for one of the lighter approaches. And the fair value one comes in handy in that context. So the way it works is kind of like arm's length pricing for reinsurance treaties. Essentially, the reinsurer would take a small share between 5 and 10% of the underlying liability, and the reinsurance premium that we calculate sets the market price for the liability for the whole book. And essentially, you're able to use this third-party valuation with your auditors to define the value of the book for which you want to produce an opening statement. And that comes in quite handy. But of course, the fair value approach comes with a few operational aspects and with a lot of governance. And these are aspects as well on which we're happy to provide assistance as well as the risk transfer. So this is a solution that we see getting a lot of traction with clients. Now, the second one is a key one to boost the return on equity and the profitability of the business. So as you know, under IFRS 17, you will be using best estimate cash flow to value the policyholder liability and the risk adjustment to compensate for the uncertainty about the amount of the cash flow and the variability around that. So at transition, of course, you will have a difference between the IFRS 4 and the IFRS 17 valuation, because under IFRS 4, typically you're following the local gap in terms of reserving, and in that case, you have some prudency margins that are embedded in the reserves. So when moving to IFRS 17, these will disappear, and the difference between the two will directly flow through equity. So you can see that if this profit doesn't flow through P&L and goes directly through equity, at first it decreases the numerator and it increases the denominator of the return on equity, and it can severely affect this KPI. Now, what we have is a solution to help you push this profit through P&L before going into equity in order to improve this KPI specifically. So the way it works is through a quota share and the stop loss on the claims reserves, and this has to be put in place before the 1st of January 2023. And the attachment point should be above the sum of the best estimate liability and the risk adjustment, and we would cover any deviation from that. So essentially, what's happening is that the extra buffers that you have in the reserves will be parked within the reinsurance treaty, and will be retransferred progressively to the direct insurer, ensuring that the profit will flow into the P&L through the reinsurance P&L of the primary insurer. So the third and last one on the pre-transition one is kind of an optimization solution on your in-force books, because under IFRS 17, you will have some books which do not yield a lot of profit. So you will be grouping your businesses between profitable, almost onerous, and onerous, and you will see which businesses actually consume capital, create volatility on your balance sheet, but do not yield a lot of profit going forward. So here the solution is fairly simple. It aims at improving the return on risk capital, because you want to get rid of these books that just consume capital and do not yield profits. And to do so, we would essentially create the effect of an economic finality through reinsurance. So it would be a quota share with a very high cession on the in-force. Could be 80% or 90% to keep the alignment of interest. But essentially, the risk would be transferred to the reinsurer, and therefore you would just decrease the amount of capital that you need to hold for it and the volatility that it might create in your P&L going forward. So now moving on to the post-transition solutions. So these are solutions that could be applied once you have the opening balance sheet and the business is running at normal speed. So a key element that Neil mentioned was the asymmetric treatment of profits and losses under IFRS 17. So as you know, the losses will be recognized upfront, while the profits will be amortized through the CSM, and this can create quite a bit of volatility in the P&L, but as well with this increased transparency around the profitability of each block of business. This can create a bit more scrutiny from analysts, and the way we would support with that is through transferring this day one hit from onerous contracts to the reinsurer. And the way we would do it is through a very small quota share with a cession between around 5 or 10%, which will be there all the time. And once the contract becomes onerous, we ramp up the session. So it's kind of a variable session quota share. We ramp up the session, and the loss gets transferred to the reinsurer. And I mean, the obvious question is, how is this solution financed? One thing we can do is to cross-subsidize with a more profitable book, and to have a small session quota share as well on the smaller but more profitable book, to get compensation as a reinsurer for that. So this mitigates the volatility that you would see from onerous contracts. Now the risk adjustment. I mean, the risk adjustment is an interesting concept. It reflects the compensation that you would need to set up for the uncertainty in terms of timing and the amount of the cash flows arising in the future from the business. So when preparing the opening balance sheet, the insurers will have to identify the risk adjustment associated to all their portfolios. And some of the portfolios will have risk adjustments that are so high because of the high volatility that it would turn the books onerous, because the CSM, so the risk adjustment will just will overrun the amount of profit that you would see in the portfolio. And managing the risk adjustment can help accelerate or defer profits as well, because the risk adjustment is released with a different pattern than the CSM. And what we can do through reinsurance is to optimize the specific amount of capital buffer. not only on a net basis, but on a gross basis as well, because it's quite obvious that if you cede part of the business on a proportional or even on a non-proportional basis, you would transfer some risk and hence some risk adjustment. So that's on a net basis, quite obvious. But it can also help on the gross basis. And the way it works is through, when you secure the reinsurance when writing the primary business, you will have more confidence in the pricing. If you cede some of the risk as well, you take a smaller absolute risk in terms of the absolute deviation of the business. And in that case, if you look at the way you set up the risk adjustment, you have a confidence interval to pick. And in that case, you can pick a more lenient one. And this would decrease. So since you have more confidence, you can take a broader confidence interval to calculate your risk adjustment, and hence have a lower risk adjustment because of the reinsurance backing on the gross basis as well. So that could be an interesting solution to help boost the profitability of the portfolios in terms of the in-force. And the last one is around the volatility. So the volatility is something that we can see arising from different sources. So with IFRS 17, we were moving to market consistent valuation, and it can go from, it can come from actuarial and reserving assumptions. It can come from interest rates. It can come from accounting implementation methods like the level of aggregation, the various patterns you have for the release of the CSM, the risk adjustment. If you change some of these, then you of course create volatility. So the financial steering as well. So in the past, you had some levers in terms of reserve releases to manage the volatility of the business. But there, this will disappear with IFRS 17 because of the lack of buffers. And in that case, like reinsurance can help mitigate some of this balance sheet and P&L volatility. This would work essentially as a modified coinsurance treaty, setting some assumption fixed, but taking the variations of some others. And essentially, you would see on the balance sheet a reinsurance asset that would mitigate the variation you would see on the other side of the balance sheet. And this is a solution that also gets quite a bit of traction with clients, especially around this volatility coming from interest rates and discounting, essentially. So as you can see, it's a broad range of solutions. We can help on many different issues and many different KPIs, be it the new business contribution, be it the profitability of the books, the return on risk capital, return on equity. So there's many things we can help you optimize. So we have a more detailed presentation on each of these solutions, and I'm very happy to have a more in-depth conversation and more tailor-made to your specific needs. So feel free to reach out. Thanks. Back to you, Neil.
Thank you very much, Maja. Yeah, and with that, I think also just in conclusion from my side, we hope that this presentation has been insightful to you today. We do hope that it's also helped to shift the focus about the reinsurance away from only the challenges, and that there's really some insights around the opportunities that are in reinsurance. I think what we've found is that there's definitely no one size fits all when it comes to these things. And we therefore definitely invite further engagement, be that on a one-on-one basis. Please do be in contact with Mukami to arrange that. And then lastly, we do have still some time remaining in this session. We did run through the slides relatively quickly in order to ensure we cover the broad range of things out there. But yeah, happy to clarify anything that might have been missed or just to take questions or answers. Thank you very much.
I see some hands up on the chat. If you don't mind going to Slido, just so that we can moderate that. Thank you. Neil, I think the first question is maybe for you about the loss recovery component. Okay, moving around a bit, just 1 minute.
Sure. Would you like me to start with that one, Makami?
Yes, but I see it's disappeared quickly. But yes, you can start with that one and I can take the next one.
Sure. Okay. Yeah, no, the examples around the loss recovery component, I mean, it does get quite complex. And I think maybe with a little bit limited time left, I would not bring the slides back, but what I would rather do is just to give you a basic understanding. There's a few scenarios. So you can have scenarios where your underlying cash flows on your direct portfolio is changing. And it then, as a result of an increase in claims. And if that happens, your loss component increases because of more claims expected in the future. That then directly impacts also on your reinsurance cash flows because it's a covered contract. So there's a bigger recovery, so more cash inflows that's expected. And that therefore then generates a loss recovery component. But the important thing is that the loss recovery component is directly linked to the loss component. So it's that relationship which is important. Similarly, if you have a reversal of your loss component on the underlying side because of a decrease in claims expected, then you also see a decrease in the recovery on the reinsurance side, and therefore your loss recovery component decreases accordingly. And then when on the underlying, it flips from loss component into CSM, there's a similar thing that's happening on the reinsurance side. But then where it does get very complicated is where you have movements in your underlying portfolio, which might not be covered through reinsurance, because we do know these mismatches do exist. So you might have a change in your expense assumptions. And if you have if you have a decrease in your expense assumption on the underlying, it would mean again that your loss component would decrease because there's a little bit more profitability expected. But this doesn't have any effect on the change in cash flows on the reinsurance because it's not covered. But then what does happen is your loss recovery component still changes because it's linked to the loss component. So whatever changes in your loss recovery component is actually offset by a change in the CSM. So it is P&L balance sheet, but the cash flows are entirely unaffected. But then where it gets really strange is where you have an increase in your expected assumptions, and that increases your loss component. Again, these things aren't covered by the reinsurance, so there's no change in the reinsurance cash flows. And the standard would then tells us that you actually don't do anything on your loss recovery component or your reinsurance CSM because these things aren't linked. So yeah, I think the key thing there is that like the system setup for this stuff is actually really complicated, and it does require one to, I mean, these percentages need to be recalculated pretty regularly so that you can get the right effect. It's a challenge that we're also busy still implementing in the systems, but yeah, I think that's the key thing that I mentioned earlier about the examples.
Thanks, Neil. And just for information, Maja wasn't able to be here because of another session, so we will obviously try to answer his questions as well. In terms of what solution we see getting the most traction with clients, I think we can take that. So a lot of the experience we've had with clients has been in more advanced markets. So we see several clients concerned about volatility, interest rate, for example, and we're having advanced discussions with one of the related solutions in continental Europe. We also have prudency margin release discussions on the P&C business in Central Europe. In South Africa, onerous contracts is getting some traction as people come up with the opening balance sheet and discover some contracts will be onerous and create P&L volatility. Perhaps that's something that's going to be relevant for our market as well. In the Middle East, fair value support seems to be getting some attention we have quite some advanced discussions there. So it's a range across across the board. The next one is about lapse risk reinsurance. Neil, perhaps you want to take this one.
Yeah, right, sure. I mentioned that as part of the the solvency solutions and the risk transfer. And what that's just about in risk-based capital regimes, often there is this, because you have your future profits on your balance sheet immediately, there's a lapse risk associated with it, and then the capital requirements require you to shock for lapses. And then reinsurance provide a cover whereby that shock is essentially absorbed. And then, as I mentioned, it just got some really strange treatments in different areas of the world. But at least I think in our regions, it's at least standard. I hope that answers that question.
Yeah, I see we are at the top of the hour, David. But maybe what we can do is make some final comments and perhaps jot down responses to the questions that are yet to be answered and share with you, John, to circulate to the attendees. Maybe one thing that has come up in one of the comments, maybe we didn't mention as a solution, but obviously the review of the strength of contract wordings will be important for insurers to engage with their reinsurers on that. I think there's a question around payments and honoring of premiums and claims and so on. So really the strength of your contracts is one thing that is not necessarily a reinsurance solution, but it's an operational item that will need to be addressed during the IFRS 17 implementation. Yeah, so we want to just thank you so much for your attendance and your engagement, and of course always happy to engage with you one-on-one depending on where your journey is, and obviously to engage on the industry with the industry on the way forward as we come to the final hurdle on this implementation piece. So back to you, David.
Thank you, Mukami. I see Ezekiel's hand has been up for a while. Maybe you can just give him a chance to ask his question. Ezekiel?
Thank you, David. I think for me, the question was, Mukami, a lot of insurance companies who are engaging feel that general insurance companies are not going to be as affected as life insurers. So what's Swiss Re take on this, given that some of your reinsurance solutions are looking at general insurance?
Yeah, sure, Ezekiel, I'm happy to take that one. Specifically with regards to, as it comes to reinsurance, it does depend, but it can be, GI companies can be affected. I think some of the things where we've seen a lot of concerns from clients is, again, specifically around contract boundaries. So using, premium allocation approach for direct business, but then having treaties, reinsurance treaties, which might make it fall into essentially longer than 1 year contract boundaries because of risk attaching at any point throughout the year. And then having to general model that. So that's one area. Again, the solution that Majid had presented about releasing prudency margins, that was to the extent that does exist in the GI portfolio, that's certainly also an example. And yeah, I think the other thing is, multi-year reinsurance contracts, which is quite popular in many areas of the world. These are getting a lot of attention. Again, one can actually manage these things. So I think there are things to look out for. Also, of course, volatility. So there is increased volatility with GI, specifically discounting on GI portfolios, which wasn't always there before. So that creates new sources of volatility. Also, the fact that you can't, there's less levers to manage volatility with. So I think the reinsurance solutions that specifically targeted at volatility and at absorbing onerous contracts do become increasingly important.
Yeah, and Ezekiel, maybe to add to that, I think the assertion has been that IFRS 17 will affect life companies more than non-life in general, right? So I think that's just an extension of that in terms of what you're asking. But in terms of the support that reinsurers can give, or even Swiss Re can give, I think that cuts across the board. the magnitude might be more for life companies just because they will be more affected by IFRS 17. But in terms of how much reinsurance can help, that's quite even across the board.
Yeah, thank you very much, Mukami. And just as a parting shot on your trapped capital solution, do you support annuities on the run of business solution?
So as a savings product.
On the one of the solutions you had was the run of business where you support business. Do you do it for annuities or only normal life?
Yes, no, it does apply also to annuities.
Okay, thank you.
Yes, as a disclaimer, our benchmark for number of deaths for any annuity transaction might be a bit high, but it's something that we can discuss, Ezekiel, with any of your clients.
Okay.
Thank you, Ezekiel, for that. Maybe just one question from my end, then we can just wrap it up. Are we seeing push from insurers to change contract terms so that they avoid the risk of going up to adopting the GMM model? Are we seeing that, or what's your view on that?
Yeah, thanks for the question. We have had some requests specifically targeted at contract boundaries, yes. I think a lot of it is also targeted at having contract boundaries being matching with quarter end dates to avoid modeling any new business. That's more on the GMM side. But in terms of changing contract terms, what we found is that we actually just had a client also in France that went through an exercise where they then just modeled the reinsurance under GMM and under PAA, and they could very easily prove that there is actually no significant difference in the outcome. And the standard then allows you to still apply PAA to your general model. So, I mean, there's two options. If it's quite simple in terms of just changing treaty terms and it doesn't have any economic impact, then of course it can be done. But on the other hand, there's also the option to internally assess, and then there's no changes necessary.
Thank you so much, Neil. So in the interest of time, I think you can wrap it up, and really thank Swiss Re team, Mukami, Neil, and Maja. We really appreciate this. I think Mukami, most of us have your contacts, so if any of the participants wants to engage further, can always feel free to reach out to you. And yeah, I want to thank everyone for attending this session. I hope it has addressed some of the challenges we've been discussing, and we can still discuss more. Let's share. If you have any questions, please just direct them to anyone who's in the actual working party. And if you've not joined the working party, please join, and so that we can have more engagements on this. And if there are any questions, you can always just address them to myself, to Task, and then we'll pass them through to the Swiss Re team. Thank you so much, everyone, and have a good afternoon for those in Kenya and the rest of the world.